Welcome back to Markets Midday. The big news is that the industrial output number for February has come in more or less as per expected. A little better, if you please, coming in at a contraction of 1.2. That's bad, but it is not as bad as what the economists were forecasting, which was a minus 1.8. The markets have therefore taken it positively at 1.3% higher. The Sensex is actually at practically the highest point of the day. So markets are not clearly ridden down by the contracting February industrial output number. Now joining us is a doyen of industry, Venu Srinivasan, the chairman and managing director of TVS Motors, also heading CII. So wears two hats now. Mr. Srinivasan, thank you very much. The industrial output is a contraction, but it is a little better than expected. From your own sense of your industry, the demand that you are witnessing, as well as what you're hearing or picking up from your CII members, do you think this contraction is soon likely to end at all?
Well, I think we were very despondent towards the end of last year. November, December was bad, January was bad. But since February, not only in the auto industry, but from our other members also, we are finding that there is a cautious optimism. And the rate of negative growth in some industries, even commercial vehicles, the negative rate is coming down, which means it's tending slowly from minus 60% for trucks in November, December to minus 30% probably in April. And we are expecting to see only about a 10% negative for commercial vehicles for the year. Cars and two-wheelers are expected to grow around 3%. And fast consumer goods like toothpaste, confectionery, bakery products are growing at around 8 to 10%. So we are seeing some, I would say, revival in the economy. Very slow, very little, but very cautiously optimistic.
Right. Venu, let me ask you this question related to manufacturing only. Would you yourself, as the CMD of a company and otherwise from a CII perspective, spend on capital goods? Have you seen more spending happening now than it was happening in, Jan, let's say? My second question relates to the fact is, do you see more demand, which means on a micro level, are you actually seeing that you're going to grow at 6% or 7%? Or are we, pretty much just...
No.
All right, I guess we may not have that link. We'll get back to him in just a moment. We'll see if we can get that link in just a moment. Let's check out the markets till the time we get him. Actually, what I really wanted to ask him was, when you speak to a lot of manufacturing companies, whether there is any real new spending of capital goods, not what they had already placed and they were using.
That's a bit optimistic. But if you get a yes for the second question, I think that's still saying something. Yeah. Because there is this big rural demand that we ignored all this while, which people are now speaking about. The Mofussil India, the Middle India, the Midtown India, and of course rural India, which has been untouched by the awash of liquidity, the tidal wave of liquidity, and therefore will not be impacted even if that liquidity swims away. I think we've got Venu Srinivasan back our show.
All right, Venu, if you can hear me, my question related to the fact that are you spending more on capital goods in, let's say, February or March as compared to you were spending on in September? Or are we just tinkering about with very small numbers here? And, there is really no clear indication whether demand really has picked up to the extent that we go back to our September days or our August days.
Well, I think April to September last year was very strong and very positive. And I think it will be 2010-11 before you start seeing growth of that kind. But what we were seeing in October to December was a severe slide in automobile industry. Minus 60-70% in trucks, minus 20% in cars, minus 15% in motorcycles. And that has come to very low positive growth. Secondly, exporters are seeing a huge contraction both in demand as well as inventories. So that went on till February. Again, that's now bottoming out and becoming slowly zero growth or slightly positive. But to see capex come back will be 1 year down the road, because all of us have installed capacities based on 9% economic growth year on year for the next 2 to 3 years. So most of the automotive industry would be sitting on 30-35% unutilized capacity. So you will not see capex come back quickly.
Okay, that I guess answers, Ashu, your question about whether capital goods will continue to grow at this pace. Mr. Venu, a final question to you in terms of what is industry expecting by way of policy responses. A substantial amount of policy rate cutting was done by the Reserve Bank. Are you beginning to see some kind of filtering of those rate cuts in the form of lower lending rates by banks, either to you or to your customers? Do you think that process has begun? And therefore, what are you expecting from the Reserve Bank, which is going to meet as early as April 21st?
Well, the process has begun. I think the PSUs have reduced, even as of a couple of weeks ago, about 50 basis point reduction in lending rates. But it is nowhere near what we would like to see it at. If you take CPI, CPI is probably running between 8 and 10%. We expect it to moderate to 4 to 5%. In which case, we would like to see prime lending rates to prime customers at 8 to 9% rather than at 12 to 13%. But with the government borrowing 3 to 4 lakh crores next year from the gilt-edged security market, the bond yields are remaining high, and that is not a good portent for the economy. That is why we have recommended that government should actually monetize, print about 3 lakh crores in tranches of maybe every quarter, so that they ease the pressure from government borrowing in the market.
Okay, Mr. Srinivasan, thank you very much for joining us with those details. Indeed, the RBI has been printing a goodish bit of notes in the past quarter and has committed to monetize at least 80,000 crores in the next 6 months as well. But I'm very hopeful that yields will fall. Yesterday, the crash was, so obvious. CD rates coming down from 7 to 6% for a bank paper. It's only a short while from here that manufacturing paper also starts coming down. And if you can raise from the market at 8 to 9%, banks will have to bring down. The only trouble is that yields fall only for AAA types. SMEs will continue to have to pay through their nose. Okay, that's